Hi Digital Chiefs, welcome back. So today I'm going to answer a question around should you be raising investment capital in the US instead of perhaps in Asia Pacific? A bit about my background, I've actually raised capital in the US, in Australia, done quite a few venture deals also looking at the UK and EU market. So I've invested in quite a number of regions myself. I've worked in the UK, US, and across Asia Pacific, done property development in a number of these locations as well. Today, I'm going to share about my personal experience investing in those regions, watching entrepreneurs raise capital in those regions. So first off, most of us think, or at least most of the entrepreneurs I speak to tend to have the grass is always greener perception when it comes to raising capital in the US. In my opinion, there's only really 4 reasons why you might be looking at raising capital outside of Asia Pacific. 1, perhaps you're not getting the actual investor interest that you're looking for. 2, perhaps the valuation isn't where you would really like. 3, perhaps you're not getting strategic investment advice, the right network that really understands and appreciates your product. And number 4, the product might actually not be in the best market in Asia Pacific for it to launch or for it to test or for it to scale. Now, before we dive in, I'm going to assume you're raising at least $1 million in capital. Otherwise, it's just not really going to be worth your time and effort. If you've sort of taken my fundraising course, you will know there is quite a bit involved. It takes at least 6 months to raise any round, whether that be a small or large one. This is something to keep in mind. If you're raising less than $1 million, it doesn't really matter if it's Australian dollars or US dollars, rough figure of $1 million. It's not really going to be worth the effort. You should be able to do that in your local region before you look overseas for larger amounts of capital. Unless there's a couple of caveats, unless you've got an existing network, unless you've already got an established work track record. Perhaps you're looking at raising capital in the US because you're getting next to no attention with investors here in your local region. I would say that if you are unable to raise at least some capital in your early rounds in your local region, that could be 50K, it could be 250K. I'd say at least some sort of significant amount of capital, about 250K is probably a good figure. If you're unable to do that in your local region where you have, I assume, a work history, you have a network, you have colleagues, this is a huge red flag. You're not going to have really better luck in the US, again, unless you have an established network, unless you have a track record. Those people who really understand what you've been able to actually do, seen you do other successful business transactions, worked for them, any of those sort of key outcomes is really quite important for an investor to be willing to take the risk in investing in you, in your business at early stage. It is sort of one and the same thing. You really should not be looking at raising any capital overseas unless you've raised some capital in Australia or Asia Pacific in your local region. Before you look overseas, you're just going to burn through a lot of time, a lot of money. Investors really just don't look at investing cross-border unless you've got some track record already in your local market. You can go over there and cold email, but if you're planning to build your business over there, okay, it might be worth the effort to go over there and do that. And that's really a couple of the other points I'm going to touch on in terms of why you might actually move over to the US and start your business there instead and therefore raise. But if you're not looking to do that and you're hoping just to land in the US and do a lot of investor meetings and then come on home to your local region to build the business, that tends to not work very well. You'll get a lot of no's, you'll burn through a lot of time and a lot of money. And so keep that in mind. Yes, the US does have a lot more capital, but it has a lot more competition from those who are already in that network, already have established track record. I've personally found it easier to raise capital in the US, but because I've actually worked there for 5 years and lived there and built a company there and exited, even after a few years, there's still a network there for me. That took 5 years to build. I would still always try to raise capital locally, at least some capital locally if I was to start my own startup again before I actually make the leap overseas. And I would be looking at the US as a huge market for my product and or service before I would look to bring on investors overseas. So number two, perhaps the reason you're looking to raise overseas is because you're thinking the valuations are going to be much higher in the US. This is true, but the reason for that, it's not simply just the valuations. Market size obviously is a lot bigger in the US, so this only really applies to products that have a US market or a massive global market, in which case you would have to prove that in your local market before you raise US capital. And that tends to be one of the key caveats in terms of US investors. That particular investor would have expertise in their local market, hence why they're investing based in that region. Typically, they'll have a partner in that particular region if they're looking to do deals in Asia Pacific. They'll have a partner in the UK, in the EU, if they're looking at deals specifically to that region, and relying on that partner to make strategic decisions about investments there. But back to valuations. Valuations are really as a result of the local salary. The equivalent technology role that you might be actually paying 150k Australian for might actually be 250k to be competitive in the US. This directly impacts the valuation of the company. So in addition to the market size of the US, that is why the valuations are much higher. They're looking at the market size, and 1% of the market in the US is much bigger with 10x the population. That's obviously just very general math. Not all sectors are obviously like that, but just to keep it simple, competition for tech talent is a lot higher there, and therefore the salaries are much higher, and therefore the valuations are also tied in with the salaries. If you don't have to pay the equivalent of that amount in your local region, the valuations are typically reflective of the market size, as well as the salaries it takes to duplicate what you're trying to build. One part of the formula is, well, how much would it cost to actually build the product? How much would it cost to replicate the product, if you think of it that way? This is where valuations are tied in. How much would it cost to actually hire the tech talent to build the product that you need, and therefore for a competitor to duplicate your product? So this is one key aspect of why valuations in the US are actually quite a bit larger, because the salaries are a little bit more competitive, particularly the tech talent. Technology, transportation technology to a point as well. Anything that requires a lot more investment, a lot more research and development, the US might be a better market to raise capital, because that kind of technology tends to be borderless as well. It tends to have a global market right from the beginning. It's not a marketplace where you have to really build out the local consumer marketplace. So these particular products are probably a really good reason to raise overseas. You'll probably have a little better luck raising, given it's such a unique product. You'll have very protectable IP. And again, it would have a global business market from day one. This is a little bit more ambitious products and services. That would tend to mean that you would have a go-to-market plan that's global from day one. You might start tackling an early market, but then be able to really sell very quickly to an international market. A lot of these, again, would be businesses. So one example, Wi-Fi. Australia invented Wi-Fi. Australia also invented the black box that goes into airplanes. These products are deep tech products that have a borderless market. They will tend to have a lot of research involved, and therefore being able to launch overseas very quickly and having a huge buyer market that are businesses. These will tend to be a little bit easier to attract capital in the US, because it's got very protectable long-term development pipeline IP. That would probably make sense to go where there's probably bit more technical talent, a bit more appreciation of technical talent overseas, and a lot more access to capital to refine that research and development. However, in saying that though, there are great funds in Asia Pacific that now very much fund a lot of this technology now. It certainly wasn't like that perhaps 10 years ago. That funding was around, but it was just not as much as it is available now in Asia Pacific. That might be a reason to raise in the US, or at least some of you around in the US. With that in mind, the investors would expect a strategic business development plan, a market plan that would include the US and the global market for them to have the appetite to invest. So if you're building a local consumer marketplace, that's just going to take a really long time to go overseas. If you got client interest from day one, you wouldn't be able to really launch the next day and sell the product the next day, or even just 3 months away, then it doesn't really make sense to be raising that capital in the US. There's certainly a lot more corporate venture capital in the US as well, larger corporates that have, strategic investment arms. Again, that's becoming more and more common in Asia Pacific, but there's a lot more established corporate venture capital firms in the US that they've sort of been investing 10 years, whereas Asia Pacific tends to sort of be 3 to 5 years old. So keep that in mind. You might actually have an easier time raising in the US if your particular product can be tied to a very large strategic partnership and help you launch in that local market. That tends to be a very strong indicator for investors. If you've already got a strategic investor, a strategic customer in the US, then absolutely you'd find things a little bit easier to raise capital there. So to summarize, ideally, if you are going to the US to raise capital, you want to be raising at least 1 million before you go over there. You want to be having local investors where you're building your product before you go to the US, because not having local investors is a bit of a red flag. Making sure that you are going to the US, not because you simply can't find investors in Australia, but there is just better, more strategic investors for your particular product, and the market is more suited to the US for your product, or is very much borderless. Having some investors already there is great in that market. They will obviously vouch for you. Having customers is also fantastic. So again, this really requires that you've already got some sort of connection to the US. You've already got an established network. You've already got customers. You've already got some people that could perhaps vouch for you. Otherwise, doing a bunch of meetings, raising your seed round where it's a lot less than $1 million. In my opinion, you probably don't really need that for most businesses. It's really very difficult to do that. You'll probably get a lot of meetings if you're good at cold emailing. If you've sort of looked at my course and actually taken it and gone through it, you might actually get a ton of meetings, but they won't result in investment because the investors will simply ask you the questions that I've gone through here. Are you going to launch in the US? What's your plan for the US? Are you going to be based there? All these questions are going to be repeated at you for the investor. And if you don't have a plan for global market access, you're not going to be able to raise in the US. You'll start building your network, which will be great if you're looking to raise later on and go to the US later on. But given that most startups don't have a lot of time and money, it would make more sense for you to just focus on your local region, raise some capital there, enough for the next significant milestone. Make sure your existing investors are happy, your existing customers are happy, and really look at raising a much larger round in the US when you've got a little bit more traction. For some of you might actually be based in a region where there's very little access to angel investors and very little access to venture capital. For those of you in that situation, perhaps you're building a business in the Philippines, Malaysia, Vietnam, Thailand to a point as well. A lot of those investors might actually be in Singapore and Hong Kong, for example. Again, you should be able to raise roughly 50K just to get going and have some local investors. If you are really in that situation, again, my course does take you through how to cold email, and perhaps what you do is actually cold email a lot of people in those regions, have the first meeting online just to save you time and money. And when you've got enough people who are interested, then book in those flights and the accommodation cost to actually go and do a bunch of meetings in those particular cities. You can do that obviously as well in the US, but I think if you go too much outside your region, again, unless that particular fund has a partner in that local region, a US fund has a partner in Singapore or in Hong Kong or wherever you're based as well, it is going to be really difficult for that investor to understand the market, to understand nuances. So it's just going to be really hard for you to raise capital where that investor doesn't understand that market, doesn't have an appreciation of the problem you're solving. So keep that in mind. If you are not based in a location that has any real access, then at least you can start having online conversations. Look a little bit outside your region. Don't go too far outside the region. So hopefully this has been helpful for those of you looking to raise capital in the US. For those of you who aren't aware, there are other ways, obviously, to raise capital instead of directly to investors. I actually break this down for you in this other video around the differences between venture capital, angel investors, accelerators, incubators, and labs. They're all slightly a little bit different, and the check exercises they write are all a little bit different as well. So check out that video if you are in a region that doesn't have a lot of access to venture capital funds.